funding, John and Flywheel with our New Ventures program are typically very early stage, in many cases pre-revenue. And then Greg and Malay kind of kick in when companies get further down the road, typically graduating from our programs, our early stage programs. So it's a really good lineup that we've got for you, and I want to thank all of our panelists again for being here today. A little bit about the Cabarrus Center. If I can get my slide deck to work, which apparently I cannot. Here we go. Let's see if we can advance the slides now. We can. So the event is being hosted by the Cabarrus Center. We just opened our doors a couple of months ago and are beginning to on-ramp our membership. The Cabarrus Center is focused on promoting innovation and entrepreneurship in Cabarrus County and in the greater region, including North Mecklenburg and Cabarrus County and surrounding counties. What we're attempting to do is accelerate growth, grow a community of entrepreneurs, and be a place where people can grow their businesses and thrive together. And that includes all of these partners on the slide deck. Now, this is a step and repeat, so it's somewhat of an exaggeration, but we do have about 15 program partners that are involved in the Cabarrus Center, supporting the entrepreneurship journey from very early stage to growth and established business levels. So these are all the folks that are active at the Cabarrus Center, actively partnering with us and bringing you the types of programming that we're delivering today. Flywheel is powering the Cabarrus Center. We are in the business of designing and operating innovation centers. We're growing our network. So Concord is our third location. We started in Winston-Salem. Then we added Davidson, North Carolina in the Lake Norman region as our second location. Cabarrus is number 3. And as you can see from this map, Flywheel is in the process of developing our network of innovation centers, basically following the I-85 corridor, the I-85 innovation corridor. So we are focused on helping early stage startup companies get established and get off the ground. That's what we do, and why we're growing this network of innovation centers. And without further ado, I want to turn it over to John to kick off his presentation and tell us all about the reality of fundraising if you're an early stage startup. So John, take it away.
Thank you, Peter. Let me get my screen shared here. And let me get your faces someplace where I can see them, and I'll let you read the entertaining cartoon while I am doing that. All right. Well, thanks for having me. I did a version of this for the SBTDC over in Charlotte a little while ago. I do like a 2-hour, here's everything that I've heard of about fundraising. We don't have a lot of time today. So what I thought I'd do is I grabbed, 10 or 15 minutes worth of stuff. But we really want to focus more on the questions that you have. And so we'll try and keep the formal part of this short, and then just entertain questions from all of you. All 4 of us will entertain questions from all of you. So Peter introduced the panel. The first thing I want to do is say context is important. Things are similar for someone raising money here. If you're a 3-time exited software founder in Silicon Valley, California, the different things apply than to whom we are speaking mostly today, which is a first-time founder who's at the idea stage. They're very early stage. Maybe they just got a little bit of revenue. Maybe they're not even that far along. and they're in North Carolina or surrounding areas. Early stage investing, in spite of the virtualness that Zoom has brought us all, and it has broadened some of the horizons on that, but traditionally early stage investing, particularly with angels, has been sort of a local phenomena. So the common perception is you have this brilliant idea, you write down that great plan of how it's going to work, you go out and you raise some money, you get to work building something, and you have an exit, you fill your pockets with gold, and you move on to the next thing. It doesn't work that way, okay? You've got to take little steps before you can take big steps. And you've got to have a strategy about how you're going to build that business. And I know there's this chicken and the egg that happens at the beginning. Well, I can't make any more progress because I don't have any money. There's always a next step you can take. And you have to find that small step that you can take with the resources that you have and build upon that step by step until you get to that point where you can raise the larger sums of money and really grow your company. Yes, you need to have a big vision, but just as importantly is knowing the little small steps that you're going to take to get there, so that that investor who believes in your big plan and your big vision and how big this can be, believes that you and one other person or just you can take those necessary first steps to get to that vision. So I'm going to start out talking about, where do you find money? And again, within the context of where we started. I'm going to articulate several stages here. And at each stage, you're going to be looking for different sources of money. And like everything else, it depends. There's not precise divisions, but early on, you've got an idea, you've got a prototype, you might have an idea of who your customers might be. You might be missing one or two people on your team. We're going to call that pre-seed or startup. Then maybe you've built a minimum viable product. Maybe you've shipped something. Maybe you've got a few more people on your team, but you're starting to get a little bit of a validation of your idea. And then at some point, you're going to have some proven revenue. It's going to be time to grow your product. It's going to be time to grow the sales team because you've got a recipe for selling. It's going to be time to expand. And then several years down the road, maybe you need to build a second product or a third product, add to your product line, expand to Europe. But you're really talking to a different set of investors. And at each one of these stages, you're going to be raising a different amount of money. Mitch Mumma, who was one of the partners in Inner South Partners, a local VC here in the Triangle, says you raise just what you need and a little bit more. Okay, there's no reason to go out and try and raise $5 million today if you don't know how you're going to spend it. But you need to raise a little bit more than what you think, because I can almost assure you that it's going to take a little bit longer. Rare is the entrepreneur I've seen who has met their milestones months and months ahead of time. So at each one of these stages, you're going to look for a different funding source. And your mileage may vary a little bit here, a little bit there. Might depend on your experience, your expertise. It might depend on the size of your opportunity. It might depend on the sector you're in, whether you've got a software company or a medical device company, a pharmaceutical company, a vegan, some kind of consumer product. Your mileage may vary. So often at the beginning, there are opportunities for grants and prizes. By prizes, I mean there'll be a pitch competition and you might win $1,000 for winning that competition. I'd be a little cautious about chasing those. Sometimes you can put in a lot of work and you get $1,000. Pitch competitions can be deceiving. The prize goes to who can make the best presentation, who can make the most heartwarming story. There's not a lot of due diligence, so yeah, you never know. But then there's the Ncid Grants. And if you haven't heard of us, hopefully you will look us up. We have 2 grant programs for early stage companies. A micro grant program of $10,000 where literally you just have to have a good idea with some thought behind it. You can't wake up one morning and say, I got an idea for cold fusion and apply and win a grant and you're going to be successful, because it is very competitive. But you don't have to have sales, you don't have a product. That $10,000 is meant to let you take that first step. Then we have the Ncid Grant program, which are $50,000 grants. And they typically go to companies that have demonstrated some amount of traction. Maybe they've got a couple early sales. Maybe they have some users. Maybe they've gotten a lot of feedback through customer discovery, and they need some money to manufacture some prototypes in the case of a consumer packaged good. But again, those are $50,000 grants. And our objective of the 10K grant is to get you to the 50K grant. Our objective with the $50,000 grant is to get you to the point where you can reach the next stage, be that bootstrap your company, or more likely get to another funding source, such as angels, or an accelerator program. The other place that you can get money is friends and family. For some of us, not me, that would have been a good opportunity back when I was doing the startup, but I wasn't born into the right family. But that is always a source of money. Be very careful with that. If you've got an Aunt Molly who loves you a lot and wants to see you succeed and is probably more risk tolerant at your stage than Greg or Malay may be, maybe you can get some money from her. But be very careful, because next Thanksgiving, when you sit down to Thanksgiving dinner and you went through that money and you've got no customers, it can be very awkward and you can have a situation on your hands. So make sure everybody's understanding that. But the next step is often an accelerator program and I'm just going to let Peter talk about new ventures and the kind of stuff that they provide.
So thanks, John. The New Ventures program was created by Flywheel because we felt like there was a gap in the overall ecosystem in the Triad area, and there still is somewhat of a gap statewide in my opinion, in terms of the very first money that can support a startup company moving from idea to repeatable revenue. And having repeatable revenue is kind of the bare minimum that is going to be required for folks like Malay, Shah, and Greg Brown to find you essentially ready for their consideration. And the problem we experience with a lot of the startups that we cultivate in our innovation centers is you really kind of have to quit your day job and really commit yourself to your startup to be effective and to move it along the development pipeline fast enough for it to have a chance to succeed. And so there wasn't a lot of capital available other than the NCIDEA program. And I think at the time that we started New Ventures, there was maybe one other funded accelerator program. So we designed an accelerator program that essentially offers up to $50,000 under an equity term sheet, standard equity term sheet that we offer to our startup companies. And then we can offer additional capital if that particular year's program has excess funds. We offer additional capital to our companies in the form of convertible notes on top of the standard equity terms. And again, the way this works is, like John, our program is completely focused on getting running a highly selective accelerator pipeline. So we have typically around 150 to 200 companies that apply for each cycle of our program. And we typically accept somewhere between 5 to 8 companies to get into the investment funnel and into the accelerator program. And by the time we're done with them, our full focus is to get them investor ready. And Malay and Greg can explain to you what that means.
All right, thanks, Peter. So going a little further up the funding chain, and we get to angels, which can be either individual angels or angel groups. And both Malay and Greg represent two of the more active angel organizations in the Southeast. So Malay, why don't you go ahead first, and then Greg.
Thanks, John. Venture South is a group of angel investors that operates across North and South Carolina. We have about 350 investors located in several small groups across the states. And what we're really looking for are companies that, just like Peter said, have shown that they've got a product market fit. They understand the path to revenue. They have a team. Maybe they have a proof of concept, or maybe they have some trial customers, but it's clear sort of what their primary business model is and how they intend to scale that. That doesn't mean that that you have to have all the answers, but you need to be able to lay out a plan of sort of what you hope to accomplish in the next 6 to 24 months.
Okay. And then, hi, I'm Greg from Charlotte Angel Fund. We're a group of 120 individuals, generally in Charlotte or have some connection to Charlotte, who've, as a group, we've pooled some capital for the purpose of making what we consider to be interesting and promising early stage investments. Those are typically, but not always, in Carolinas based technology driven companies. Neither the geography nor the sector are absolute. And normal for us would be to invest $50,000 to $250,000 as a part of someone's $500,000 to $2 million investment round.
All right. Thanks, Greg. And then often investing alongside of angels or after angels are seed stage venture capital funds. The two that I'm most familiar with, because they're in the triangle, are Co-Founders Capital and Idea Fund Partners. But they will typically invest a little bit more than angels, maybe up to $1 million, depending on the fund and the size of that fund and what the appetite for different investors are. And it's not until you get really a little further along that you're really going to go to the venture capitalists that have these very large funds, often hundreds of millions of dollars. And people say, well, why won't they invest in my little startup? Why won't they put $50,000 or $100,000 to work? And it's just a matter of scale. If I've got a $500 million venture capital fund, I can only manage so many investments at once. And if I'm investing in $1 million at a time, that's 500 investments I'd have to keep track of. And typically that scale just doesn't work. And so it's not till you need to raise $5, $10, $15 million are you really going to a venture capital company. We don't even have one of those on the panel here because we figure that's, for most of you, a few years down the road. All right. This is I don't want to say that this is the depressing part of the program, but I think you need to know the harsh realities of getting yourself funded. And so I'm going to bring up a couple things here. One is, I see way too often startup founders spending a lot of time trying to raise money before they're really ready. And it might be because they really don't have a fundable company. And we're going to come back to that. I'm going to ask Greg a question about that. And by fundable, I mean an opportunity that's really, really big. So I'm going to come back to that one in a minute. The other thing I want to talk about is, I mentioned these two seed stage funders. Idea Fund and co-founders. Both Idea Fund, maybe 5 years ago, got one of these most active seed stage investors in the Southeast. I think co-founders been named that a couple years ago. But I went to both of them and asked them, just give me some data so I can have an idea when I'm talking to founders, about how this goes. So it's going to be hard in a Zoom call like this. You can type it in the chat window if you want, but how many do you think each of these, each of these are 2 and 3 person operations? Okay, they've got a couple partners and then an associate. So it's 3 people located in little old North Carolina. How many plans, decks, executive summaries do you believe that they get pitched in a year? What do you think that number would be? Greg probably knows. You want to guess, Greg?
Yeah, I 1,000 would be a reasonable guess.
Right. Greg is one of the smarter people I know because he's exactly right. It's about 1,000. Okay. Greg's also on the board of NCID, so I have to say that he's a smart guy too. So.
Thank you. I appreciate that.
All right. So of those 1,000 decks that they see, how many do they actually talk to the founder? Do they get a pitch? Do they have a phone call? Do they have a meeting with them? Well, you think it's 3 or 4 people. Maybe they could do 4 or 5 a week. So they actually listen to 200 founders a week. All right. So after that initial pitch, okay, where they, okay, this looks like a pretty good idea. This looks like a really good size market. That looks like a really smart founder. How many do they actually then say, okay, we're going to spend 20 or 30 hours digging into this, doing our due diligence, talking to one of their customers, talking to some industry experts, really digging in to see if this is a good investment for our firm? Somewhere between 12 and 30. That's 71. I think they changed the associate. I think he might have been counting a little different. But at any rate, we're down to now 20 to 30 of these original 1,000. And then how many investments did those that are labeled as the most active investor in the Southeast make in those years? These new investments, not follow-on investments, new investments, about 5. It is really, really, really hard. And I don't want to discourage you, but I want to let you know that you really have to get things right. Okay. So that's what you're up against. So when should I talk to an investor? First of all, you should know your investor. Okay. If you've got a ginger beer business, don't waste time talking to idea fund partners, because they typically just invest in software companies. Okay, know the kind of stage and the kind of business and sector that your investors invest in. Don't pitch them before you're ready. But that doesn't mean you can't talk to them. Okay, if you're at a very early stage, almost everybody I have met across the state of North Carolina who invests in companies is willing to have a cup of coffee with a smart entrepreneur. So there's nothing wrong with calling and say, hey, I've got a company, we're building widgets, and I'm not ready for an investment right now, but I'd really like to get some feedback on it. Do you have 10 minutes that I could buy you a cup of coffee and I could just let you give me some feedback and critique on this? And almost everybody will. I mean, it is an amazingly friendly ecosystem around here. The other reason that you want to do this is investors like to, they say they invest in lines, not points. And what I mean by that is they're looking to see, are you building momentum? Are you gaining traction? Are things going in the right direction? As opposed to, we had $2,000 in sales last month. That could be good if you just started. It could be terrible if you had 20,000 the previous 5 months, right? So they want to see these lines. And by having that early conversation, you sort of start that line at a really small point, and you start to then get feedback and work with them. And then at some point, you'll be ready to actually talk to them. And finally, there's an old saying in the in the nonprofit world, which we're part of a nonprofit, it says, if you want advice, ask for money. If you want money, ask for advice. So at this stage, just go ask for advice. Getting to yes is on you. Okay. And remember, investors are not deciding on your idea in a vacuum. They're comparing your opportunity with all of the other opportunities that are put in front of them. And they know they're only going to make 4 or 6 or 8, some small number of these a year. So it's not just about you, it's about all their other opportunities, and you have got to be the one to get them to yes. Investors are really reticent to say no, okay? They don't want you to get mad at them. They don't want to find out that, oh, I thought this was a really bad idea. I told this guy no. He went down the street to Greg. Greg talked to them. Charlotte Angel Fund just invested $200,000 because they saw something that I didn't. And now you've already said no, okay? So you have to temper what they're saying. And if you're not seeing a term sheet, that's no, all right? If they say yes, that means maybe. If they say maybe, that means no. If they say I'm interested, that means no. No, of course that means no, but you're never going to hear that. And that doesn't necessarily mean that 3, 6, 9 months from now, you won't have that opportunity for them to invest. If you are getting I'm interested or maybe, it's on you to figure out what it is that that investor would want to see to make an investment. Ask them. They may not tell you, but it's on you to ask and learn from that. So with that, I'm going to look for your questions in the chat window. And while we're waiting for a few of those to come in, I'm going to start one off with Greg, if I can get my windows right here. And I want to talk about this, this opportunity. Why is it that you're looking for such a big opportunity? And since Greg and I chatted beforehand, we actually have a slide to get you started on this. So I'm going to let Greg talk to this one.
Yeah, thanks, John. I thought it would be useful for founders to understand how it is that angel investors make money, right? What's in this for us? So this is data from a study that was done over about a 20-year period. And let's focus on the blue. The blue is US data. So on average, the cash on cash return for angel investors is 2.6x over the life of the investment. So invest $100,000, get $260,000. Yes, it matters with the length of time, but that game doesn't sound so bad. But you need to think about this as a roulette wheel. And there are different spaces on this roulette wheel for lose all your money, get your money back, win 2 times your money, etc. So if you see on the left-hand side, that left-hand bar, over 50% of the time, over half of this roulette wheel is lose your money. Over half. And then, you can see the distribution of these returns, and it drops off pretty quickly. And those of you who have taken statistics classes could probably surmise that to get to an overall average of 2.6 times your money, you have to have, once in a while, that roulette ball has to land on I'm getting 10 times or more my money back, right? So every one of these opportunities that we invest in has to have the potential for a big outcome. And what does that mean? That means that if things go well, if this business is well executed, the kind of general economic conditions are favorable, that that this business becomes of substantial size and creates substantial value. So that, what does it take to do that? You have to be able to scale in a pretty capital efficient manner. This distribution of outcomes is really what's in the background behind all the questions that Malay and I might be asking about. Well, what's the market size here? what a particular founder is doing might be interesting, but if the market size is small, it can't ever get big enough to get us 10 or more times our money, right? If this is just software that can only be used by florist shops in Mecklenburg County, North Carolina, just if for whatever reason the market for that product was limited to that, it would never get big enough. So this is why we care a lot about, and everybody keeps asking you, well, what's your market size? What's your TAM? It's also why we care about valuation, right? Because how do we get to 10x? In the end, there are two data points that matter. What price did we pay and what price did we sell at? And that valuation that we're investing at, that's our starting point. And so it's why investors are valuation sensitive. And this also speaks to why market size matters to us.
Thanks, Greg. All right, so we got some questions coming in, and I want to focus on the ones that y'all are asking. So Robin McIntyre, I'm just going to read them rather than wait for everybody to unmute and mute and get yelled at because you didn't unmute and all that. So any trends coming out of COVID that you see, and any changes that we're going to see, coming in the next couple of years or the next year, Malay?
Thanks, John, and great question. The primary thing that's changed over the last year is that we're getting much more comfortable with B2C businesses that are virtual. Over the last 6 months, consumer preferences have changed enough that we're seeing real changes in both what customers will tolerate as well as what they're looking for, their expectations. That would be the biggest change, I would say.
Greg or Peter, do you have any thoughts on that one?
I would add there as an investor. So we've now had the experience of investing in 3 companies with whom we've never been in the same room. And that never happened pre-COVID. So I would say that it's made geographic boundaries less important than they were before.
Yeah, I think though, I would also add that it's also changed the screening a little bit. COVID has positively affected some startup companies in terms of their market opportunities, and it's made it more difficult for others, particularly if your go-to-market strategy is heavily dependent on in-person sales calls. It's been a very difficult environment for those companies, and they've had to either develop a workaround or a different strategy. So I think it's changed the way we're kind of filtering for go-to-market strategies as well.
Yeah, I think as far as our grants, the only difference it's made for us is it's now a factor in your business. So for example, we've had some ed tech companies apply for grants, and ed tech, they got challenges right now just teaching reading, writing, arithmetic, and revenue, and things that like that. So that's been the impact for us. Bill Freeman wants to know, what are some common causes for companies not getting funded after due diligence? Malay, you want to start with that one?
Sure. One of the primary reasons I think will be, there's probably 2. One would be a material misrepresentation, as in, we have so many customers, but when we talk to 2 or 3 customers, we're interested in buying the product or service, but we haven't actually bought it. That does happen from time to time. And as a founder, you want to be optimistic. At the same time, you need to be realistic as well. And then the second is coachability. Through our due diligence process, we will be meeting either virtually or in person many, many times, and we will make some suggestions and see how you react. A typical investment horizon is 3 to 7 years. So we are essentially getting married. So we're going to go on a couple of dates and see how you behave.
I think for a group like ours, so our members have, prior to getting to due diligence, our members have seen a 10-minute pitch and had 10 minutes of Q&A. That's it for our general membership. And they'll say, yeah, that's interesting enough. We'll do due diligence on Malay's software company. And now we're going to have a 2 to 3 hour due diligence meeting with Malay. I think where we're really forming our assessment as to whether do we think this is the right team is happening during that due diligence meeting.
So let me follow up on that. So what percentage-ish of companies that pitch you actually make it to that due diligence stage?
For us, it would be, of those who get invited to present at our meetings, a third are making it into due diligence.
And then what's the sort of time required, resource requirement for a startup to go through that due diligence process?
I'll speak for our group and then Malay can answer. I would say most of them already have their documents in reasonable order. So they probably would spend 2 hours compiling a response to our request for information or documents. And then they would invest 2 to 3 hours in a meeting with us.
Our process is similar. It's probably a little bit more drawn out, mostly because we've got investors across North and South Carolina. And so meeting with, we want to get some consensus across our multiple groups. So in terms of the actual time, it's similar, but if you want to think about elapsed calendar time, a due diligence process could end up taking 60 days, maybe.
So one thing I can add to, what something Greg touched on, which is part of getting investor ready is getting diligence ready, i.e. getting all of your documents organized, understanding what the angel groups are going to be asking for, which is something that John and I, take responsibility for preparing our startups to be in a position to do. And, there are red flags in due diligence documents. For example, the cap table might have, non-accredited investors on it, or there may be something a little bit messy with the friends and family money situation that needs to get cleaned up. And if those things aren't resolved quickly, it can move you to the bottom of the stack.
All right. We've got a question about the market size, which Greg, you touched on. So for each of your funds, do you have a threshold of, okay, the market opportunity has to be $1 billion or 100 million or 10 million or even ish? Greg, go ahead.
No, there's not. So we don't have a single number. You must exceed this threshold. What we're looking for, in every one of our due diligence reports, we're doing math to say, well, what would the conditions need to be for us to have a 10x or better return on our capital? And ultimately that comes down to, an assessment of what percentage of the market do we think this company would have to attain to achieve a 10x return based on this valuation. And, that needs to be possible on a market attainment of something like 2%, not 20. And so, realistically, you do have to have, you typically would have to have market size of $500 million or more. You think about it, $500 million at 2% would get you 10 million a year. If you're a software company, 10x on that 10 million a year would be $100 million exit value, which is kind of, the starting point for getting 10x your money would be, can we exit for 9 figures?
Malay?
Yeah, that's exactly, I would say, rule of thumb at right around between $500 million and $1 billion. That doesn't mean, tomorrow, just eventually.
Right, that the potential is there. And that's what I refer to as an investment thesis. So something that's really important for everybody on the call to understand is that the angel groups and new ventures mitigate our risk through a portfolio strategy. So we're screening for a 10x return on capital, knowing that not our entire portfolio is going to achieve that. That's really important for you guys to understand, is that the slides that you present to the investors, if the math doesn't achieve what Greg just iterated, then there's no point in presenting to the investors.
I do want to point out for Ncid Grants, our math is a little different. At one time, it was strictly, are you an investable company, which then means you have to have those kinds of market sizes. But our math is around economic impact in the state of North Carolina. And we measure that through jobs and revenue that the companies that we help achieve. And at one point, that was strictly the lens we looked at it through, is, can this company get to be that big? And the thing that happened because of that is most of our grants were going to companies in RTP, maybe in Charlotte, in the urban centers, and yet our mission is to the whole state of North Carolina. And so for us, you have to see your way to multi-million-dollar revenues and or 50 employees or more over the next several years. And part of the reason that math changed is, if we could fund some company in Mount Airy that could grow to $10 million in revenue and had 75 employees, the impact on that community from our perspective would be just as great as a $100 million software company in Charlotte. So it's a little different for us because we're a foundation, but I just wanted to point that out. But that's not to mean we exclude those kinds of companies.
That's a great point, because there are different support resources for different types of entrepreneurial journeys. The entrepreneurial journey that Malay and Greg are concerned with is highly scalable companies. There are plenty of other entrepreneurial journeys that can grow to different levels and get different types of funding. But today we're really focused on the scalable.
So every time I do one of these, the question about crowdfunding comes up. The pros and cons of crowdfunding. Personally, it just seems like it's almost there. It's almost there. Maybe it's finally getting there, but it's now been around a while. What do you think of the pros and cons of crowdfunding, Peter?
I think I'm going to kind of defer to Malay and Greg on this a little bit, but my opinion is that crowdfunding is an appropriate funding vehicle for lots of kinds of companies. It's a little bit messy in terms of getting a crowdfunding component on your cap table for a highly scalable company. And I'll let Malay and Greg take it from there. So I think it's an important form of funding, equity-based crowdfunding. And several of our companies have pursued that and done well with it, very well with it, raised, $250,000 or more in an equity-based crowdfunding campaign. But it was appropriate for the kind of company and for their goals in terms of growth to go that route. It's not necessarily the best route to go if you're going to move on to angel fund or to a venture capital fund kind of source of funding. So Malay and Greg, love to hear your thoughts.
Peter inserted a word there that is important, so let's limit the discussion to equity crowdfunding.
Right.
One of our observations has been that the most successful crowdfunding companies have been companies where the crowdfunding investors can be advocates. So for example, if they can be salespeople, if they can be influencers, that's where it really makes sense to have a broad set of investors, i.e. through crowdfunding. If you're a business to business type, then that doesn't make quite as much sense.
Yeah, and I'd summarize it. I agree with what's been said. If it comes down to it, for the most part, if we're looking at investing in a company and looking at their cap table, I would prefer to see a, let's say an angel group or something like that. If you said, hey, Greg, which would be better for me to have, like Venture South or crowdfunding, which one makes it easier for you as the next funding round? I would rather have the organized group than the crowdfunding. Simply because it's more of a known to me, it's more comfortable, and candidly, I'll express maybe some old man bias that I tend to think that a company that's done equity crowdfunding has been unable to raise money in the way that they would like to via the traditional markets.
One nuance to this, though, is non-equity based crowdfunding. If you're a product startup or a B2C type startup, an advantage of running a Kickstarter campaign or something like that is it helps to demonstrate customer validation and customer traction. So that can be a useful strategy in some cases for product and B2C type startups.
Yeah, and there are other places where crowdfunding can be appropriate if you are one of those companies that doesn't have the $500 million market opportunity, that might have a $10 million market opportunity, and you can structure the deal to be perhaps a return on revenue, a royalty stream back to your investors. If you're a brewery or a tea house, or, there are businesses where I think it is more appropriate, and others where it's less appropriate. From Brian Francis, at what point is it reasonable for a founder to start taking a salary, and do you have parameters that you expect to be followed? Malay?
Want me to start? I can kick that off, and Malay. So we think it's important for founders to take a salary and not, work for free. But by the same token, the salary should not overload use of funds.
If an entrepreneur is so worried about where they're going to get groceries, then they're not spending time on the company. So it's just very practical for us, and it's a case-by-case situation.
Yep, but agreed. But I think what the founder, frankly, everyone on the core team needs to be in on is they're not going to make market salaries at their startup. And if you or people on your team need to make market salary, I need to make what I could make working at Bank of America, then being in a startup isn't a rational decision for you to make. That doesn't mean you're a bad person, but if you need a salary of $250,000 a year, then being in a startup, founder or say one of the key core team members, that's a drag on the capital and a drag on the cash burn that the startup probably just can't carry.
Yeah, and it's also a signal that they don't understand the exit, the need for that high multiple exit that's out there in the future. That's what drives and motivates people to take less than a market salary at a startup.
As far as our grants are concerned, you asked about specific parameters. We explicitly don't have specific parameters because we're sort of testing that. Does somebody just want to take $50,000 and use that for 3 months of salary? We're sort of listening to them, but we absolutely don't mind people taking rent money and hamburger money and enough to keep you going. Malay and Greg, a question for you. If your company faces steep international competition, is crowdfunding more difficult?
I think steep competition would always make any kind of funding more difficult.
Yeah, I think you're right. Let's see, did I miss any here? Okay to have a market size of $500 million or $1 billion as a global market. Yeah, I think that $500 million or $1 billion is worldwide. It's not just in the US. If you have a food product that is different from the norm, what kind of share do you look for when looking for an investor? I'm not quite sure what you mean by share there. I'll start out just speaking to Ncid Grants. When it is a consumer packaged good, whether it be a food or a widget that's sold to consumers, we are, that's a lot about the brand. And so we are looking, I think, for a little more traction in terms of sales and brand, even if it's in a small subset of the community. If you're doing gangbusters selling this product at 2 Whole Food stores in Chapel Hill, and there's no reason why, if you had money to expand, you couldn't expand outward. That's just as good as having a tiny amount of sales across a bunch of outlets. Do you guys even do you see consumer packaged goods companies at Venture South or at Charlotte?
We do, but your point about marketing dollars is spot on. Branding is incredibly important. And so generally for CPG type companies, we're looking for companies that have an unfair distribution advantage. Because if you're just going to compete with the large brands, then it's just going to be a money suck. But if you've got a unique way to get to the customer or a cheaper way to get to the customer, then brand building makes a lot of sense.
Yeah, I would say for us, the reality is, so we don't state that we exclude CPG companies, but the reality is that the amount of traction that it would take to get us comfortable means making an investment, because I don't know what the attributes are of an early stage going to be awesome snack food company. I really don't, right? And so therefore the amount of traction I would need to see to say, oh, this is really something I want to be involved in, means that, it probably would be far enough down the road that they've had to get a lot of other investors already. We're probably not a good target for companies in that sector.
Peter, how about you? Do you do CPG companies in your accelerator?
Yeah, we do. And I concur with Malay. It's all about how are you going to get your product distributed in a way that makes sense in terms of an investment thesis. So that's the main focus.
Chris Bourne asked if you're seeing any trends regarding the type of startups investors are looking at. In the past, the preference seemed to be tech. Are you seeing any moves towards advanced manufacturing and advanced materials? It might be helpful, start with Greg, sort of why a software company makes it a little bit easier decision for you. And then do you make company or investments in advanced manufacturing or materials?
Yeah, so software capital efficient scale. And I would also say for us, we're far more comfortable with B2B software than B2C. And really, we're far more comfortable with anything where the buyer is a business rather than a consumer, because we feel like we're better able to predict the buying behavior of a business than a consumer. Both will involve emotion, but consumer will be even more emotion driven than a business. And sometimes I don't know what, whether a consumer is going to gravitate towards, a new style of jogging wear or anything like that. The tough thing about advanced materials, specific to our group. So each angel group takes on the personality of its own membership. Our members are composed of different people than Venture South. Here in Charlotte, we have a lot of people who come from the financial services community and not a lot of people so we have a lot of finance and MBAs. We don't have a lot of science or engineering sort of background. So that makes things like advanced materials a difficult thing for us, because we have a hard time evaluating those things. We just don't feel like we have the requisite skill set within our membership typically.
Malay?
Very similar. The reason software is so attractive is because you can leverage technology. Your software is working at night, even if you're not. But if you're talking about actual manufacturing, you need to have bodies on the ground, and you have to have expensive and large capital outlays for capital expenditures and plants. And it's just really hard for you to grow that in a capital efficient manner. There are a couple of exceptions. Advanced materials is a good one, especially if it's past the point of kind of R&D. That can work, and we have invested in a couple of advanced materials companies.
And Malay, I think to the point of, it's somewhat specific to the region and the investor group. For example, I think Greenville, South Carolina, the Venture South group down there is very interested in the manufacturing and advanced materials sectors. But what you said still applies, right, in terms of how you filter and select. From a new ventures perspective, the regions that we serve with our Flywheel locations have very strong manufacturing sectors. And what we're looking for is the intersection of innovation or technology with manufacturing or advanced materials. That's kind of a subtle nuance, but it's where tech does play with those market verticals that we feel is very interesting. So for example, in the Charlotte region, there is a strong manufacturing environment in the surrounding counties and in Mecklenburg County as well. And if you ask the question, what is the future of manufacturing? You're going to get into robotics. You're going to get into cybersecurity as it relates to manufacturing, and you're going to get into innovative software type technologies intersecting with manufacturing. So I think there is interest in those kind of intersections, and just asking yourself what the future of those sectors looks like.
As far as our Ncid grants are concerned, that we definitely make grants to companies like that. It is often, a $50K to get some piece of equipment that they can't afford, that they need to demonstrate a prototype or something like that. But we've often done that. Got a question about sustainable advantage. He's got a sustainable advantage for 3 to 6 months for a short amount of time, but competitive advantage for a short amount of time. Can we get suggestions that can help us get a proper competitive advantage, or does a competitive advantage completely eliminated? I mean, if you can't figure out how, I'll be kind of blunt. If you can't figure out how you're going to keep the competition at bay long-term, even if you don't have to have that built today, but if you haven't figured out a way to keep that, I think any investor that's looking at you, that's going to be a pretty tough hurdle to overcome.
Yeah, we're looking for innovative intellectual property that can be protected as a core evaluation in, I think, what all of us on the call do. So, there's two kinds of competitive advantage. One is the best team for the idea and their ability to execute rapidly and get out in front of the market. So that's the advantage of speed and excellence of execution. And then the other advantage is, building a moat around your startup in terms of your intellectual property.
Yeah, I wouldn't, I would just say though, to whoever asked that question, well, and to others, I bet something nearing half of the companies we've invested in probably, I may have overstated that, significant number don't have any patents, right? Software companies often don't have patents. So when you're saying, what's my sustainable advantage, I would think to some of what Peter was describing here in terms of the team and the ability to iterate and move quickly. It's not always just about patents. And conversely, having a patent doesn't mean that you have something of value.
We got a couple questions about if something's fundable. I think that's really hard to answer in the context of a 2-sentence description. So I think I'm gonna skip that one. I think. Does this end at 1? Or are we keeping
I
going?
think we can continue a little bit after if everybody's got.
All right. Well, let me ask you this question. I think you often learn more from what other people, what has gone wrong or a mistake that someone's made. But tell us, if someone that's pitched your organization and why don't you move on? Why don't they move on to due diligence? What are some of the most common reasons that, you just say, sorry, not for us? Malay?
I'll talk about one of my personal pet peeves, and that's the sentence, any sentence that starts, if we just capture 2% of the market, we're done. Because I'm not interested I mean, market size is important, but I'm really interested in how you're going to reach that 2% of the market. How many salespeople are you going to need? How many calls are they going to need to make per day? Build up from the bottom up rather than the top down.
That is mine too. And I have a little bit different perspective on it. Is 2%, you're not defining your market smart enough, because who owns 2% market share of the of the operating system business? The losers. You've got Android, you've got iOS, you got Windows, you got Unix, right? Don't define your market in a way that you're going to dominate it. We're right on the same page there. Greg, go ahead.
Yeah. So I've got two of them. One is you have to, as a startup founder, you have to be a good storyteller. And but you have to be able to tell the story to your employees, to your customers, to prospective investors. You've got to be able to convey what you're doing. And there's nothing worse than the founder who does their 10-minute pitch. They leave the room, and you know what the discussion is afterwards? I don't even know what the hell business they're in. It happens, and shame on me if I let that person up there, right? Because I should have screened them out. But you should practice your pitch. You need to practice it to where it's understandable to somebody who's not from your industry. So with none of the jargon, whatever, what Malay and I and Peter and John want to be able to do after we hear that pitch is to, at dinner that evening, I want to be able to utter 3 sentences to my spouse about the company that we saw this evening, right? Oh, they're doing X with Y, and they're targeting, African-American millennials as a market, whatever, right? Be able to tell your story and also understand the norms. There's nothing worse than a company who you hear about it, you like the business, and then something funky about their construct. They want to put the IP in this separate company and license it back to this other one, or they have some funky financing structure that they just. It's not hard to figure out what the norms are out there. There's a ton of content out there on the internet about how these deals are usually structured, all that. Just don't fight that. If the norms are raise money in one of these 3 instruments, and basically middle of the bell curve is going to be terms are going to look like this, if normal is going to be a 15 to 25% discount on your convertible note, don't come to the table with 5, right? It makes the whole discussion not about your business, but about the terms. And you're losing if that's what the discussion is.
Peter?
Yeah, I think my pet peeve is, I completely agree with what Greg and Malay have said, particularly the storytelling, the ability to articulate clearly what is the problem you're solving and how are you solving it. Then it becomes a matter of, is the timing right? And do I really believe that this team can execute? Is this the right starting point? And we know that it's not a fully fledged organization, right? Frequently, it's just a couple of founders. But do they have what it takes to drive the execution of the idea and get it to market and fulfill that investment thesis? So my pet peeve is when a startup presents to me and I know more about their market than they do. That really annoys me. the founders should be the market experts. They should have all the research under their belt. They should know the market vertical in which they're operating. And I know that it annoys investors to know when the investors know about the founder's market than the founder does.
Those are all mine too, but I'll add one more. We have no competition. You know, I'm sorry if you have doing nothing is competition, you know, just the status quo is your competition. And what's worse is when I Google your industry, and I find a bunch of stuff that looks like competitors, you run the risk that I'm going to misinterpret that and that they're actually not your competitors. So you have competitors, own it. Tell us why you're better. Tell us why you're different.
Yeah.
All right. Peter, you want to wrap up?
Yeah, I think this has been excellent. I always learn from you guys when we're on these kind of calls or at conferences and conventions focused on the startup ecosystem. So I appreciate it very much. Malay, if you want to put your contact information in the chat so people can follow up with you. Same with you, John. Greg's already done that. We'll give everybody a few minutes. We'll leave the call up for a few minutes so you can copy stuff out of the chat. John, there was a question of are you going to share the slides? Do you feel comfortable sharing your slide deck with the audience?
Sure. And I see it's being recorded.
Yeah. So
I don't know what the mechanism for.
I guess you've
accessing-
already shared it.
Yeah.
So thanks again, everyone. Thanks very much for being here today, and thanks for getting to know a little bit more about the Cabarrus Center and the resources that we're bringing to you to support your entrepreneurial journey. Thanks very much, guys.